All right, everyone, welcome. Going to be recording the lecture on bonds today. See what I did there? It's Module 3, Day 2, and we are in Chapter 12. This is Section 12.3. This is on bonds. So we just learned about stocks. Now we're going to learn about bonds. We're going to do a little bit of bond pricing to figure out what factors determine the price of a bond. We're going to talk about how to interpret the bond quotes that you'll see and where to find them. Then we're going to talk about the different types of bonds that you could access. And then lastly, finish up with how bonds are rated. So what is a bond? We've been through this a little bit, but they're liabilities of the issuer. So they're debt to firms. So if a firm sells a bond, they are essentially borrowing from the bond purchaser. We saw this on Sprint's income sheet, where we see sales, and out of sales, before any profits are paid out in dividends to stockholders, we have to take care of the interest expense. So, true, false, explain. What do you think? Bonds have higher rates of return than stock. Well, that would be false. Generally, bonds earn less than stocks do because they're less risky. So, remember how in the last lecture we talked about how bondholders are paid first if a company goes under, and then the stockholders are paid. It's less risky to hold a bond. You get regular interest payments, whereas with a stock, your payments depend on the success of the company. It's not always true that stocks are better than bonds. This is looking at stock indexes and bond market indexes from 1994 to 2014. And we see that if I invest $10,000, that amount is getting quite large with stocks. Then when we have these little recessions, we see dips in the performance of stocks, large dips. Bonds are generally recession proof. They have fluctuations that are certainly harmed by the recessions, but they're always growing at a steady rate, whereas stocks are fluctuating much more wildly. And so year to year, you can get much bigger growth out of a stock. But if you need reliable income, you might be looking at investing in bonds. All right, let's try another true false. Like a stock, a bondholder owns part of the issuing firm. That is also false, right? As a bondholder, you don't own anything. You don't have any ownership of the firm. You don't have any voting rights. You're simply lending to the firm. Let's try one more. Stocks are treated more favorably by the U.S. income tax system than bonds. And this is true. So interest income is taxed as ordinary income, whereas dividends and capital gains have their own special tax rate. So in general, we get more favorable tax treatment from bonds. All right, so let's go through some bond basics. When you look at bond prices, you're going to see several things. The first of which is a par value. This is the amount that's going to be paid to the bondholder at maturity. So if you buy a bond, the par value is what you're going to be paid back at the end of the bond. So if you have 1,000 par bond, then at maturity, the company is going to pay you your $1,000. The maturity date is simply specifies when the bond is to be repaid to the bondholder. And the coupon rate is important because bonds also possess annual interest payments. Just like you trying to pay off your loan and you pay interest, companies will pay interest to you, and that's specified by what's called the coupon rate. Coupon rates are annual interest rates, but they're usually paid semi-annually, so twice a year. And let's look at an example of that. Let's consider a 2-year bond. You see here I've got the years to maturity, 2 years, $1,000 par, and a 4% coupon rate. And we're going to assume that the investor buys the bond at par value. So the first thing that happens is a cash outflow of $1,000, so we buy the bond at par. The second thing is we receive coupon payments. So the coupon rate is 4%. That means every year I'm going to make $40 in interest, except with most bonds, it comes semi-annually, so you get $20 every 6 months. Half a year, $20. Half a year, $20. half a year, 20, end of the bond, your final 20. And like I said, the last thing that happens is you get repaid the $1,000 of the bond at maturity. Now, one thing to note is that bonds rarely sell at their par value. And this has to do largely with interest rate risk, but also risks of the company. But let's think about this. Suppose you buy a 3-year, 3% coupon bond at par. The yield on that is going to be 3%, right? You make 3% annually in coupon payments, so 3%. However, let's suppose you buy it and bond rates immediately increase to 4%. Bond rates immediately go up. So would you be able to sell that bond that you just bought to someone else for $1,000? Well, the answer is no, because there's new bonds out there that they could buy for $1,000 at 4% coupon rate. So why would they pay you $1,000 for your old bond with 3%? Their new bond, the 4% coupon, offers greater yield. So let's think about how to compute a bond's yield to maturity. If you have a 3% bond and current bonds are going at 4% coupon, then your price must adjust to have it to equal the yields. So what does that mean? What do you think has to happen to the price of your bond if you have a 3% coupon when other bonds of similar maturity have 4%? Well, the price of your bond has to go down, right? The seller needs to buy it at a discount in order for them to be okay with the fact that they're receiving lower coupon payments. And we can figure out what that price will be. The future value of a bond is $1,000. Each year we receive $30 of payments. There are 3 years, and our annual coupon is 4%, right? And so the question is, what does our price have to be to equal the yield of all the other bonds? And we would do the present value calculation. So let's go to our calculator. One thing I want to show you is I have a $1,000 future value, 3 years, $30 payment, and the current bonds are going at 4%. So we can compute the present value to see that the bond will be priced at $972.25. Whenever a bond is priced this low or priced below par, we call that a discount bond. So it is priced at a discount. And it has to be because current coupon rates, other bond yields are higher. So it needs to be priced lower to have the same yield. So now you try it. Suppose that instead, right after you buy that 3-year, 3% coupon bond yields fall to 2%. So yours is actually a little bit better. What's going to be the impact on the price of your bond? Give that a try. Okay. Future value is still 1,000, 30 payment. The only thing we're changing is the yield that the rest of the market is getting. Well, my bond's better, so you should have found that the price of your bond is higher. In other words, to compensate you for the fact that your bond has a better interest rate than what's on the market, they pay you a little bit more money. And so whenever a price is above par like this, we call this a premium bond, selling at a premium. Now, interest rate risk isn't the only thing that affects the price of bonds. Some bonds might have lower prices because the company is more risky, as well as it depends on also the length of maturity. So what I'm showing you here is if we invest $1,000 in a bond at 4% coupon, what the price will be if the market rates differ. So this bond has 4% coupon, and so let's just consider it being a 5 years to maturity. If the market rates are 6%, while I have a 4% coupon bond, then the price of my bond is going to be much lower, right? If market rates are 5, it's going to be lower. However, if market rates are lower than the coupon rate on my 5-year bond, my price gets to be higher. And we notice that the benefit of being locked into one of these favorable bonds with a higher rate than market is larger the longer you have the loan. So what this suggests is that when rates are rising, when rates are going up, you want to be in a short-term loan, right? So if I'm in it 5 years for this bond and interest rates begin going up in the market, my price falls a little bit. It's much worse, however, if my bond has 20 years to maturity and rates have fallen. And so it's better to be in short-term bonds when rates are falling. When rates are going up, however, I want to be locked into those long-term 20-year to maturity bonds because there's a lot of value there and the price is going to go up. Of course, you're making coupon payments all along the way, but you can also sell these things at capital gain as well to make money. Okay, so what types of bonds are out there? Well, we talked about treasuries, U.S. Treasury bonds. These are issued by the U.S. federal government. They are the most secure type of bond that you could find. Almost no risk, but they also have a very low return. One benefit of these, though, is that they're exempt from state income taxes. So different levels of the government don't tax each other. This is a federal security, so the states are not going to tax something that the federal government is using to raise money. Agency-backed securities are interesting. These are obligations of subdivisions of the U.S. government. And so an example of this might be like the housing authorities. They have slightly larger yields because they're a little bit more risky than treasuries. And one big example is the offerings from Fannie Mae and Freddie Mac, mortgage-backed securities. So I have a video for us to watch on mortgage-backed securities.
Mortgage-backed securities, or MBS, are a type of bond representing an investment in a pool of real estate loans. To understand what a mortgage-backed security is, we need to go over what happens when a bank issues a mortgage. Let's look at how a mortgage becomes an MBS. Tony wants to buy a house costing $500,000. Usually, Tony would go to his bank and apply for a mortgage for $500,000. And in return for loaning this money, the bank would make Tony pay interest on the loan at, say, 8%. Before the world of mortgage-backed securities, the bank would simply keep this loan on its books and receive principal and interest for the duration of the loan, say 30 years. One downside of this arrangement was that the bank had to keep this loan for 30 years, tying up capital and resources. One day, the bank had an idea. It could sell the stream of interest, the 8%, and principal payments from Tony's loan to investors to get it off the bank's books and free up capital at the same time. The bank would make money simply from originating and servicing the mortgages and from other associated fees. In order to sell the interest streams to investors, the bank bundles Tony's loan together with hundreds, maybe even thousands of other mortgages. Then the bundle of mortgages is sold to an investment bank in the form of a single bond. The investment bank partitions the pool of loans according to quality and sells the sections to other investors. So although Tony makes payments to his bank, the loan is actually in the hands of investors. Mortgage-backed securities are essentially a way for banks to free up capital and provide a way for investors to buy into mortgages.
Yeah, so Fannie Mae and Freddie Mac are not government entities, but they're government-sponsored enterprises. So they're private entities created by the U.S. government, but they participate in the private borrowing markets. Other examples of agency-backed securities are like student loans. So the Student Loan Marketing Association does the same thing. They sell off your student loans to investors, and those investors make money when you pay back your student loans. So when we're thinking about treasuries and we're thinking about agency bonds, they're quoted a bit strangely. So if we go to the Wall Street Journal, you can find quotes for all types of financial instruments. But here I've pulled up the bonds market. And so let's just take a look at 30-year U.S. Treasury bond. We could see right here that the price is a little weird, 101 and 28 out of 32. So the price is quoted in 32s. So you have to divide this out to see that the price is, it was actually 30 out of 32s this morning. So let me run this real fast. $101.8750, which means a $100 par bond sells at $101.88 almost. So is this bond selling at a premium or a discount? Well, these are currently selling at a premium, right? Because they're selling above par. Let's also take a look here. What's the semi-annual coupon payment? Can you figure that out by looking at this information here? How much would you receive every half a year in interest payment? Okay, well, if you bought $1,000, let's say $1,000 bond, the annual coupon payment is 3% of that, or $30. So you're going to receive $15 every 6 months. Other types of bonds, municipal securities. This is the topic of your workshop today. You're going to look up municipal bonds that were created by Baldwin County to help fund the hospital, the Oconee Regional Medical Center. But municipal bonds are unique. They are issued by state and local governments. Their interest is that you receive, the coupon payments are free from federal tax, right? Local governments are not taxed by higher levels of government. However, there's generally a small yield associated with these municipal securities. But they do come with big tax breaks, right? The higher marginal tax bracket that you're in, the bigger break you get from the interest being tax-free on municipal bonds. And the last one we'd like to talk about is corporate bonds. So corporations can borrow from you as well with corporate bonds. And these are obligations of the corporation. There's many different types and maybe many different varieties of corporate bonds, but the first way to differentiate them is to compare based on who gets paid first if the firm goes under. Talking about risk here. Senior bonds are secured, so they're attached to specific assets at the firm, and these bondholders will get paid back even if the firm fails. But unsecured bonds and holders of subordinated debt in that order have to wait till all secured bond holders are paid first before they would get any money if the company had to be liquefied. Finally, you notice down here the stockholders are the last to get paid, and that's part of where the risk of holding stock comes from, is that all the bondholders get paid first. Sometimes you'll hear unsecured bonds, also called debenture bonds. These things are just secured by a promise that the company will pay. Bonds can also vary in the way in which you are paid your par value. Sinking fund bonds are bonds that are paid off slowly over time instead of all at maturity. So you might seek out this bond if you don't want to give away, let's say, your $1,000 for the entire life of the bond, but get paid back slowly over time. That's valuable to you because if you have that income back, you can invest it, right? You can earn interest on interest, essentially. Call features are important. So sometimes businesses have the opportunity to pay off your debt early. You, as a bondholder, might not want this because you might have been desiring the level interest payments that you get each half year. So if a company has a call provision and they exercise it, they usually pay you what's called a call premium. They say, okay, we're going to pay off your bond. So here's your par value. Here's your $1,000. We're also going to pay you the next year of interest payments that you would have gotten. So you do lose out because you don't get the entire stream of interest payments, but you do get some compensation for, you get your $1,000 back and you get paid for a year in which you didn't actually have to lend them the money. So that's good. Convertible bonds. these bonds are interesting because they combine the price protection of common stock with the downside risk protection of bonds. So if you buy a convertible bond, you hold it for a specified period. At some point, you can convert that into the company's stock, and that's good because if prices go up, the value of your bond goes down. So you might want to convert that bond into stock to protect against the inflation risk. However, if you're holding your bond and prices are going down and rates are going down, you might want to just hold on to that bond and not convert it because you're better off holding on to that solid rate you have and that fixed income with that bond. Also, if the markets are going really crazy and we're maybe hitting a recession or the company is kind of looking unsure, you want to keep that as a bond, right? Because you get paid first and you don't want to be a stockholder. So corporate bonds are quoted more straightforward. There's several ways you can find listing of corporate bonds. We're going to look at FINRA here. So pull up the bond market. Let's search a company. I'll pick my wife's favorite company in the whole wide world, Target. I might be personally responsible for any price appreciation that occurs from time to time. But here we got, for example, this first bond here, a price is quoted in the hundreds, 132.564. So if you bought $1,000 worth of this corporate bond, it would be $1,325.64. Now you notice that most of these bonds are currently selling at a premium. The lower interest, lower coupon bonds are the ones selling at a discount. It's clear that over time, rates have improved. Coupon rates are improving on corporate bonds, as perhaps Target is doing stronger as well. One thing to note about bond quotes is that what you see is not what you'll actually pay, and that's due to accrued interest. So what you'll be quoted is the price of the loan or the price of the bond, but it doesn't include the interest that's accruing between coupon payments. So let's say you get paid a coupon payment at the end of July, and it's May right now. Well, we've gone through several months where the company owes you interest or owes that bondholder interest, but you don't see that in the price. So what you pay when you actually buy a bond is called the dirty price. It's the quoted price plus accrued interest. The clean price is what you see. It's what we just looked at with Target. It's the quoted price. So if you're 3 months into your coupon cycle and you get $20 in that semi-annual period, then the price needs to be adjusted for that time that you let the company borrow the 3 out of 6 months. And so we simply add half of that coupon payment onto the quoted price to get the dirty price. Now your book has an error. They say that the clean price is the quoted price minus the accrued interest. That's not true. The clean price is just the quoted price without any accrued interest added onto it. So this is what it should be on 337. Make that adjustment. All right, finally, bond ratings. So you'll see next to bonds several different types of firms that give several different types of ratings. And this just refers to how strong they think the company is and how likely the bondholder is to get paid. These investment grade bonds are high quality, and you shouldn't really worry too much about the company failing. You should be getting your level interest payments. There should be no problem. But then we have down here junk bonds. Junk bonds are really not secured. The company could fail, sort of a risky investment. But which would you expect to have higher yields? Well, it would have to be the junk bonds because they're going to compensate you for the risk of investing in something that might not be so secure. Okay, that is today's lecture on bonds. So go check out the workshop. Don't forget to comment on the discussion boards. You need one every day this week, and be looking forward to Thursday's stock market game.